Welcome to the monthly outlook on markets. April month can be perfectly described as a tale of two halves. In the first half of the month, markets nosedived, largely due to the tariff war initiated by the US administration. The initial announcement of tariff led to a sharp decline across major markets globally. However, later, when a signs of more reconciliatory approach emerged, that helped global markets stage a partial recovery in the second half. Despite this rebound, large global markets including S&P 500, Euro stocks, Hang Seng, Nikkei and Kospi remained down for the month till date. Interestingly, Indian markets did relatively better compared to other markets globally. This resilience, to our minds, can be attributed to India's robust domestic economic growth, relatively lower exposure to global trade, and also the optimism around a potential India-US trade agreement. Interestingly, foreign institutional investors' inflows played a significant role in supporting this rebound. Let us now delve into the changing character of markets. Volatility has become a norm and may not go away in a hurry. Interestingly, markets have witnessed unusual calm for a length of time. Hence, the current volatility is a rude awakening to many. In the current environment, we believe markets will keep shifting goalposts from one event to another, and trying to predict or outsmart markets in the short term can be futile. Investors, to our mind, are better off thinking about long-term shifts and trends in the global economy and position portfolios for the emerging global order. We believe one needs to understand the strategic objectives of key players in the ecosystem, those that are driving the tariff shifts to reshape global dependencies and those resisting this change. US has grown increasingly concerned about its dependence on China for critical goods, viewing it as a long-term strategic vulnerability, particularly in the context of rising geopolitical risk. Conversely, China, having long benefited from supplying low-cost goods to the United States, is now seeking to reduce its reliance on the US dollar and shift focus towards domestic consumption and high-value sectors. Both nations are moving towards a deliberate economic decoupling. We believe that these objectives have an ability to redraw global supply lines. Amid this realignment, India stands a chance to be a beneficiary. India offers scale, has a large and growing domestic market, and geopolitical neutrality, positioning it as a credible alternative in global supply chains. We need to focus on areas where the country has strength and has the right to win. So let us now delve into who can be the potential beneficiaries of this change. The ongoing US-China trade tensions and the broader trend of economic decoupling between the two nations have created significant opportunities for Indian industries across several strategic sectors. To start with, electronic and equipment manufacturing. In this area, India is emerging as a viable alternative to China for global supply chains, driven by government incentives under the Production-Linked Incentive Scheme and increased interest from multinational firms that are looking to diversify their production bases. In pharmaceutical, Indian contract research and development organizations are benefiting from increased outsourcing as global companies seek more cost-effective and geopolitically stable partners. Defense sector, to our mind, is also poised to gain. Opportunities are growing for joint ventures, technology transfers, and co-manufacturing under India's Make in India and Atmanirbhar Bharat initiatives, particularly as Western nations look to reduce dependence on China for defense components. Additionally, India's rapidly expanding digital ecosystem is attracting investment in data centers and undersea cable infrastructure. This is positioning India as a regional hub for digital connectivity and storage. Another sector to our mind which actually benefits is the power sector. There is potential for Indian players to participate in clean energy transition, especially in nuclear energy, as countries seek alternatives to Chinese involvement in critical infrastructure. Together, these sectors represent India's potential to emerge as a key strategic and economic partner in the post-globalization world order. Some of these are not yet represented in the investable public market universe. But over the next few years, we should see such investment opportunities emerging in the Indian equity markets. While the sectors mentioned are the direct beneficiaries of the shifting global order, a broader wave of secondary gains can also unfold. The positive spillover from increased investment, manufacturing activity, and strategic relevance has potential to uplift India's economic growth trajectory. In essence, the structural tailwinds created by this global realignment present a decent long-term opportunity, provided we execute it well. That is the key. As we move to a different growth path, indices may or may not be the right representative, as potential beneficiaries may have limited representation in the indices currently. We may also potentially see changes in the index constituents over period. Let us see how corporate earnings have been so far. The March quarter earnings season has started with a mixed performance across sectors. Expectedly, IT companies reported results that fell short of already muted expectations, reflecting ongoing demand softness. Given the global conditions, current year, that is FY26, also seems to be a year of slow growth for the sector. In contrast, lending, especially banks and NBFCs, delivered strong results, surpassing expectations on the back of healthy credit growth and stable asset quality. We expect credit growth for the system to remain in 10 to 12% range, with pressure expected on net interest margins for banks. NBFCs in general, with their relatively higher share of fixed book, can see some benefits. Meanwhile, the FMCG sector continues to face headwinds, with tepid revenue growth and emerging margin pressures, highlighting the challenges in adapting to the changing consumer demand and cost dynamics by the sector. The opportunity lies more in areas that can see penetration-led growth along with benefits of premiumization. Overall, when we look at FY25, it has been a year of mid-single-digit profit growth for India Inc. We expect a recovery in profit growth in FY26, driven by a rebound in government capital expenditure, boost in consumption driven by benefit of income tax cuts for the middle class, decent rainfall, and also the likely onset of interest rate cut cycle. Thank you.